For technology industry, we have chosen Aemulus Holdings Berhad, while for telecommunication industry, we have chosen Maxis Berhad. Aemulus is defined as to be equal or better than competitors or to emulate, and to eliminate competitors usually by killing. The name is self-explanatory. A group of engineers distinguish the significant process oblivious to many which has become the ultimate weapon of semiconductor industry. Aemulus innovation is none other than a type of disruptive technology which positively disrupt existing market since 2004, and the story continues. Maxis Berhad is a communications service provider in Malaysia, headquartered in Kuala Lumpur, Malaysia, providing a variety of communication products, applications and value-added services for consumers, large enterprises and small and medium business owners.
My name is Nur Adilah binti Rohaizad, and I will present on similarities and differences on FAR660 between Aemulus Holding Berhad and Maxis Berhad. FAR660 is our revenue from contracts with customers. It is to provide one comprehensive revenue recognition model for our contracts with customers to improve comparability within industries, across industries and across capital markets. The first similarities between Aemulus and Maxis is both effective and applicable beginning from 1st January 2018, and they were recognizing their revenue at an amount that reflects the consideration to which an entity expects to be entitled for transferring goods and services to customers. First difference is on performance obligation. For Aemulus, sales of equipment is generally expected to be the only performance obligations, and for Maxis, devices that transferred as part of an bundle package with mobile telecommunication services to be considered as distinct, and this accounted for as a corporate performance obligation. Second difference is on disclosure. For Aemulus, they disclose about the relationship between the disclosure of disaggregated revenue and revenue information disclosed for each reportable segment. And for Maxis, the amount of transaction price allocated to the remaining performance obligation and on explanation of when the revenue is expected to be recognized are not disclosed. Next, FAR660 lists the similarities between Aemulus and Maxis is both companies are applicable but not yet effective, and the effective are on annual periods beginning from 1st January 2019. The differences is on expected potential effect. For Aemulus, the group expected any potential effect on the financial statement will happen, but on Maxis, the group did not expect any potential effect on the financial statement in the future.
Assalamualaikum and hi, I'm Aina, and I'm going to present the similarities and differences between Maxis and Aemulus on MFRS 119 and 126. Okay, the first one is MFRS 119, which is employee benefits. So the differences between those companies is for Aemulus, they recognize the short-term employee benefits as expenses, but for Maxis, they recognize it as liability, which is accrued expenses. Okay, for Aemulus, which is they have short-term benefits, is categorized into two, which is accumulating and non-accumulating compensated absences. For accumulating, it is paid annual leave, which are recognized when services are rendered by employees that increase their entitlement to future compensated absences, while for non-accumulating is sick leave, which are recognized when the absences occurred. Okay, that is for Aemulus, while for Maxis, it is recognized as liability right. So it is stated there the group recognizes a provision where contractually oblique or if there is a past practice that has created a constructive obligation. And also the amounts measured are expected to be paid when liabilities are settled. Okay, just so you know that MFRS 119 does not have specific disclosure about short-term employee benefits. So next is on long-term employee benefits on Aemulus and Maxis. So for Aemulus, they has no long-term employee benefits, but for Maxis they have, which the obligation arises where the service is rendered, and it is presented as current liabilities in SOFB. Okay, moving on to MFRS 126, which is accounting and reporting by retirement benefit plans. Okay, so they are both the same for Maxis and Aemulus. They both are recognized as expenses in profit and loss. So it is stated there in Aemulus that Malaysian companies have EPF, so they put pension in National Pension Scheme, which is EPF, while for Maxis, they stated that the company has no legal or contractual obligation to pay for their contribution if they have not sufficient assets.
Hi, my name is Nabilah. I'm going to present similarities and differences of MFRS 2 share-based payment between Aemulus Holding Berhad and Maxis Berhad. MFRS 2 is about share-based payment. It is a transaction in which the entity receives goods or services as consideration for equity instrument of the entity or equity instrument of another entity within the group. As from Annual Report 2017, Aemulus Holding Berhad and Maxis Berhad both have not applied MFRS 2. Share-based payment will be effective for annual periods beginning on or after 1st of January 2018. Maxis mentioned in their annual report that they introduced an exception to the principle in MFRS 2 that will require an award to be treated as if it was wholly equity settled.
My name is Iffah and I'm going to present the similarities and differences of MFRS 9 between Aemulus Holding Berhad and Maxis Berhad. MFRS 9 financial instrument replaces MFRS 139 financial instrument recognition and measurement and all previous versions of MFRS 9. MFRS 9 brings together all three aspects of accounting for financial instrument project, which is classification and measurement, impairment and cash accounting. Both Aemulus and Maxis adopt the new standard for annual period beginnings on or after 1st January 2018. There is reclassification of equity investment from available for sale financial asset to financial asset at FAR660 for Maxis. As for Aemulus, the group's investment in unit trust does not qualify as equity investment and does not meet the contractual cash flow characteristic of a debt instrument under MFRS 9. As such, the investment in unit trust will be measured at fair value through profit or loss upon adoption of MFRS 9. Both Aemulus and Maxis applies the MFRS 9 simplifies approach to measure ECL, which uses a lifetime expected loss allowance for all trade receivable and contract assets.
Moving on to MFRS 132, financial instrument presentation. A financial instrument is any contract that gives rise to both financial asset in one entity and a financial liability or equity instrument of another entity. As offsetting the financial instrument, both Aemulus and Maxis Berhad offsetting their financial assets and financial liability, and the net amount is reported in the statement of financial position if and only if there is an currently enforceable legal right to offset the recognized amount and there is intention to settle of a net basis or realize the asset and settle the liability simultaneously. As for similarity between Aemulus and Maxis Berhad, Their financial liability are classified as current liability except for maturity greater than 12 months after the reporting date, in which case they are classified as non-current liabilities. The differences between Aemulus and Maxis: Aemulus financial liabilities are subsequently measured at amortized cost. Meanwhile, for Maxis Berhad, financial liability is measured at fair value to profit or loss. The similarity between Aemulus and Maxis Berhad in available for sale financial asset, both is measured at fair value. For the differences between them, Aemulus impairment losses of available for sale financial asset will be recognized in profit or loss. Meanwhile, for Maxis Berhad, the impairment loss of available for sale financial asset will be recognized in other comprehensive income.
Moving on to MFRS 7, the objective of this MFRS is to require entities to provide disclosures in their financial statements that enable users to evaluate the significance of financial instruments for the entity's financial position and performance, and the nature and extent of risks arising from financial instruments to which the entity is exposed during the period and at the end of the reporting period, and how the entity manages those risks. Both Aemulus and Maxis applies MFRS 7 financial instrument disclosure by disclosing the qualitative and quantitative disclosure about risk. The risks are credit risk, liquidity risk, interest rate risk, and foreign exchange risk. In notes to statements, there are qualitative disclosure about those risks for both Aemulus and Maxis. There are also quantitative disclosure about credit risk, liquidity risk, interest